Rather than relying on third-party organizations to pool pension assets until their scale justifies professional management, smaller funds always have the option of simply commingling their assets together so that they might collectively have sufficient scale to employ professional management and invest in some of the larger, more difficult to subdivide asset classes like buildings or professional sports teams. Now, the first major organization to take this step was the Caisse de dépôt et placement du Québec, which was a collection of small Quebec-based pension funds who decided that they would band together in order to be able to support the necessary organizational infrastructure that would allow them to break away from external management or simply relying on broadly available capital market funds. So starting in 1965, the CDPQ ultimately became a pioneer in diversified pension strategies by moving away from the fixed income market and into the equity market. Now, despite this kind of early leadership, however, its directors, which are appointed by the province of Quebec, have sometimes found that the fund has demanded local support for various firms that are based in Quebec. And the government has sometimes required them to prioritize investment in local funds over necessarily seeking higher risk-adjusted returns abroad. Now, what this does, despite any sort of political complications, is ultimately ensure that money from Quebec is employed within the province. And while this might not be the most mathematically efficient, it does certainly support local industry and help keep down the cost of capital, which in the eyes of the government maintains employment and thus enhances social stability. Always remember, when we're trying to understand the behaviors of governments, that their motives are not always purely about maximizing risk-adjusted profits, and that they often have other more complex utility functions that need to be considered, which can sometimes involve making political decisions which don't always seem to be economically optimal. But Canada's big pension plans aren't just known for their diversification. For the most part, they're also known for their large direct investments and their participation in an active governance of firms in which they invest. In general, Canadian pension plans manage more assets in-house than their international peers do. For relatively smaller Canadian firms, those managing less than 50 billion, what we find is that about half of those assets are managed in-house compared to about 1/4 internationally. When we look at pension funds with more than 50 billion, as much as 80% of those assets are managed in-house in Canada versus only about 1/3 globally speaking. So this has really come to be known as what is internationally regarded as the Canada model, in which pension savings are channeled directly into productive capital without the intermediation of external managers. In other words, our funds aren't investing in REITs, they're buying real estate development corporations directly. They're not investing in actively managed funds, they're operating actively managed funds in-house, and thereby cutting out the need to channel a fraction of these fees to shareholders who might otherwise absorb some of the operational risks of investments. Instead, by bringing these factors in-house, Canadian firms managing pension funds have consistently been able to offer better returns than is otherwise expected. In fact, a paper recently published by Berthelier, Flynn, and Spenner that was ultimately released at the latter half of 2020 had the following to say. This paper presents a quantitative portrait of Canadian pension fund model. The authors show that between 2004 and 2018, Canadian pension funds outperformed their international peers, both in terms of asset performance and liability hedging. A central factor driving this success is the implementation of a 3-pillar business model. This is what people mean by the Canada model, incidentally, which consists of 1, managing assets in-house to reduce costs, 2, redeploying resources to internal investment teams for each asset class, and 3, channeling capital towards growth assets that increase portfolio efficiency and hedge liability risks. The authors point out that this model works best for funds whose pension liabilities are indexed to inflation. But one particularly juicy quote from their paper, which is linked in the slides below, suggests that not only did Canadian funds generate greater returns for each unit of volatility risk, but they also did a superior job hedging their pension liability. The ability to deliver both higher returns and insurance against liability risks is notable because hedging is typically perceived as a cost. Now, of course, not all the big pension plans around the world have taken this kind of approach. In fact, Japan's GPIF has outsourced the management of their $1.5 trillion fund to 35 different pension fund managers around the world to reduce perceptions that have a conspicuous sort of influence. Conversely, when we take a look at how Norway has managed their funds, rather than hiring specific managers who will try to beat the market but compete against each other at the same time, they simply dispensed entirely with active management. Norway's Statens Pensjonsfond Utland, or SPU, ultimately invests over $1 trillion into what can be described as a global index fund. Roughly 60% of the pension is allocated towards global equities, another 35% towards global bonds, and a last 5% invested in specific real estate around the world. Generally speaking, the SPU operates under a mandate of epistemic proceduralism, which is to say that they are as transparent as possible, even to the point of being inefficiently transparent. And this is, again, generally done to assure the host countries which receive these investments that Norway isn't planning anything strategic in particular and is focused instead on simply earning highest risk-adjusted profits that it reasonably can. But even though the SPU is largely known for this kind of broad index strategy, one of the other aspects that makes it particularly notable is its social investment policy. Many people have questioned the nature of this simply because Norway's fund is backed entirely by its reinvestment of its oil export profits, but Norway has moved significantly to divest itself from certain kinds of investments, which its people have found troubling over the years. This leads us ultimately to be able to discuss perhaps Canada's most important pension plan, which is the Canada Pension Plan itself. The Canada Pension Plan was founded in 1965 and involves the participation of roughly 20 million Canadians. In 2019, it collected from about 14.5 million people and then paid out benefits to another 5.6 million. To help understand the structure of this plan, it's important to note that it is effectively a defined benefit pension, but the benefit that you collect is scaled to the size of your contributions up to a particular maximum. In general, what they'll do to calculate your benefit is consider how much contribution you have made up to a particular maximum in every working year of your career since age of 18. It will average out these lifetime contributions and then pay out 25% of the indexed amount of income. So for instance, until recently, the maximum contribution income for Canada Pension was in the range of $50,000 to $60,000, which would mean, of course, that the maximum potential benefit would be 25% of this amount. So if your average lifetime contributions, or your average lifetime income, rather, from which your contributions were drawn, averaged to $48,000 a year, then the benefit that would be paid out to you would be 25% of that, or $12,000 a year. Now, the Canada Pension Plan is not nearly as generous as some other pension plans are, state pension plans are around the world. But remember that it's designed to be a supplement to individual pension savings through the RRSP system and the employer-based pension system. So in Canada, like many other countries, we do employ a 3-pillar pension system, and the Canada Pension Plan is ultimately designed to be a wide base to help cover a number of people who might not otherwise have employer pensions to contribute to. Now, originally, the Canada Pension Plan was supported by relatively small contributions. Just 3.6% of someone's income was required to be contributed, half by the workers and half by the employers. And this continued apace for almost 20 years before in 1986, people began to recognize that demographic concerns, the decline in the number of children and the extending lifespan in Canada was ultimately going to lead to underfunding problems. And between 1986 and 96, the combined contribution of workers and employers systematically rose until it finally reached 6%. But in 1996, another assessment of the system determined that this was insufficient, that in fact the small reserve fund which had been built up would be destroyed within just 20 years. By 2015, there would be no reserve fund left, meaning that the government would necessarily have to borrow or tax on an ad hoc basis in order to meet the obligations that it had made to Canadians. And so an important sort of rescue plan was organized, whereby contributions would be increased and the money from these extra payments would be used to build up an asset base whose yield could ultimately supplement contributions. The goal of this sort of plan was that ultimately roughly 1/3 of the obligations of the plan would be supported by this investment pool, meaning that in the years before we end up with such a significant amount of elders relative to our workers, we might be able to build up enough money such that the decline in the number of workers relative to elders that's expected later this century won't be as severe. Therefore, contributions were increased again. Remember, in 1996, they were approximately 6% were the total combined contributions. But by 2003, total combined contributions had reached just under 10%. And the government decided to establish the Canada Pension Plan Investment Board in order to have some professional management that would oversee all of these extra contributions to ensure that the fund could grow sufficiently large to protect the interests of beneficiaries. Now, the Canada Pension Plan Investment Board, or CPPIB, has been followed a similar sort of management path to that, trailblazed by the Caisse de dépôt et placement and further reinforced by the Ontario Teachers Pension Plan. Canada Pension Plan has also been a direct, active, and ultimately relatively sophisticated investor, earning since 2006 an annualized net return of about 9.5% after all expenses. If we compare this again to the TSX's performance during this period, what we see is that the Canada Pension Plan is actually outperforming the broad stock market and doing so at a reasonably low cost. Although the costs did rise in 2020 to a total of 82 basis points, they have historically run between about 50 and 75 basis points. So unfortunately, last year's costs were a little bit high, but it's worth pointing out that in terms of the returns being earned, we're looking at a spread of anywhere from 4 to 3.5% above what is actuarially required. What that means is that the Canada Pension Plan requires an average return of 5.5 to 6% over the long run in order to match contributions against outlays. Instead, it's been earning 9.5%, which has actually seen us move above our target level of assets by 2020. And we hope to be able to maintain some of that surplus in order to be able to deal with years where the plan might not be as successful. Now, 2016, another review of the plan was done, and recognizing its successes, decided to expand it even further. For many years, I've complained that the Canada Pension Plan actually doesn't take enough of my money, that if I could earn a 9.5% return as consistently as the plan has been earning it, that I would be happy to surrender even more of my paycheck to them. Well, in 2016, we saw the beginning of this. The plan's reformulation will see an increase in the maximum earnings ceilings that Canada Pension Plan uses in its calculation of your benefit, and it will also strive for a higher replacement rate. Instead of replacing 25% of your income to a $50,000 or $60,000 cap, over the next half a decade, we'll see that cap rising to almost $75,000 roughly, and the income replacement on that rising as high as $33,000. This is expected ultimately to help keep a lot of our senior citizens out of poverty as we progress throughout the century. But of course, contributions are also going to be higher to pay for this expanded benefit. By 2025, the combined contribution of employers and workers will have risen to 11.9%, nearly 3.5 times what the original Canada Pension Plan's combined contribution was back in 1965. But don't despair. While many people have complained about the rising premiums, it's important to recognize that we've also been increasing the magnitude of the benefits associated with the plan, and that frankly, its returns have been rather startlingly good. During its most recent actuarial report in 2019, actuaries found that the plan was solvent through at least 2093. Today, looking at the plan, We're sitting on an asset pool of roughly $410 billion, which is expected to reach as much as $3 trillion by 2050 before the plan stops growing and finds itself in more of a steady state principle. It's worth having a brief look at this image in the top right-hand corner here. It may be challenging to see, but it does point out a couple of key things that I can describe to you. You've got a copy of the slides. I'd encourage you to simply expand the image and see it better. But for those who are simply following the videos, I'll summarize the contents of it for you. In 1999, Canada Pension Plan had assets of roughly $36 billion, 100% of it, which was invested in Government of Canada bonds. 10 years later, the asset pool had grown to $98 billion, of which roughly 2/3 was equity, 1/3 fixed income, and another 5% in real assets. Out of this amount, 2/3 was invested in Canada and only 1/3 abroad. Fast forward to 2020, the plan has $410 billion worth of assets. It's roughly 53% equities, another 25% fixed income, and 24% real assets. Of these total portfolio, now only 15% of it is actually invested in Canada, with 85% of it being invested abroad, where the CPPIB has determined we have excellent opportunities for the future. So the future is relatively bright for the Canada Pension Plan compared to the doom and gloom that we encountered in the 1990s when we felt we were staring off the edge of a demographic cliff. It's good to recognize that if we can identify these kinds of problems early, that there are opportunities to save the plan. And this is how we should be thinking about a number of financial redesigns. They may not always be doing what we want, but there are opportunities for us to correct path and to ensure ourselves a brighter future.